Imagine millions participating in the economy every day, working, renting, paying bills, yet invisible to the traditional financial system. They are entirely invisible. They leave no trace. In the United States alone, the traditional credit system categorizes 30 to 35 million consumers as unscorable. An unscorable consumer is someone with a thin or non-existent credit file. To a legacy lender, these individuals effectively do not exist. This creates a strange paradox. We are living through an explosion of digital information. Look at this trend line showing the projected volume of global data. Between 2009 and 2020, we saw a 4,300% increase in new data points generated across the digital landscape. Yet, despite this massive influx of trackable information, the percentage of the population locked out of the financial system has remained stubbornly flat. Look at these horizontal lines showing the 7.7% of the population that is completely unbanked, alongside the 20% who remain underbanked. But if we look closer at that unscorable group, the data tells a different story. When analyzed using a wider set of parameters, roughly 10 million of those supposedly invisible consumers actually demonstrate financial habits that would earn them a prime credit score of 600 or higher. This brings us to an architectural solution known as the data mosaic. It works by cross-referencing thousands of alternative data sets to extract highly predictive insights about a consumer's true financial health. Traditional underwriting relies on an exceptionally narrow set of variables. By strictly limiting what counts as valid financial behavior, that legacy system ghosts millions of reliable, viable consumers from the modern economy. To understand why legacy systems fail, we have to look at how traditional credit scoring is calculated. It evaluates risk based entirely on temporal snapshots, rather than measuring continuous day-to-day behavior. The core unit of this legacy model is the standard billing cycle. This diagram illustrates the mechanical length of a consumer credit cycle, functioning as a rigid, one-dimensional timeline that tracks exactly 30 days. The cycle is defined by a hard mathematical boundary at the end of the month, known as the statement closing date. Notice how the transactions populate along the timeline. The closing date mechanically captures a static snapshot of your outstanding debt at that exact millisecond, calculating it into a single statement balance figure right at the barrier. That specific balance is then divided by your total credit limit. The resulting mathematical percentage is your credit utilization ratio. Credit utilization, the percentage of available credit you are actively using, is the foundational metric that gets reported to the major credit bureaus to build your legacy risk model. Interestingly, this closing date is entirely separate from the payment due date. A second marker appears here, typically 21 to 30 days further down the timeline. This gap functions as a grace period. If you pay the full statement balance by this second date, the system does not charge interest. The entirety of a consumer's traditional financial profile is dictated by these strict mechanical rules, 2 specific dates and 1 primary ratio. Relying on a single isolated snapshot creates massive systemic blind spots. It penalizes consumers whose financial reliability is consistent, but falls outside the parameters of this 30-day trade line. Most of a consumer's actual financial life occurs completely off of those standard credit card rails. Think about recurring financial behaviors. Consistently paying rent on time requires high-level budgeting and cash flow management. The same applies to consistent utility bills and telecom payments. These are strong secondary indicators of deep financial health. Watch how these non-credit behaviors interact with the legacy underwriting model. The rent and utility payment data nodes physically bounce off the rigid timeline. They remain entirely unrecorded by the system. Because the system cannot process this data, it simply evaporates. The consequence is that a highly responsible consumer is categorized in red as unscorable simply because their behavioral data does not fit the required bureaucratic format. The Center for Financial Services Innovation identifies the solution to this gap as trend number 1, getting granular through getting huge. This marks a shift away from narrow metrics towards integration of massive datasets. Big data underwriting platforms like LexisNexis and FactorTrust are actively building new architectures to capture this missing data and evaluate previously invisible consumers. True financial resilience is proven by continuous, diverse daily habits. A once-a-month statement balance snapshot cannot capture that reality, which makes a completely new data architecture necessary. This new architecture is the data mosaic. Cross-referencing thousands of alternative datasets built a complete, holistic profile of a consumer. To visualize this, we have to move past the one-dimensional perspective. The timeline rotates and expands into a three-dimensional isometric base grid, ready to accept multiple distinct streams of information. First, we layer a new plane over the base grid. This represents non-traditional credit, populated with previously rejected rent and utility data nodes. Next, we stack another layer. This maps geolocation and digital footprint habits, tracing online behavioral patterns. Finally, a fourth layer is added for personal financial management. This integrates granular bank account histories and real-time cash flow analytics. A primary real-world application of this multi-layered architecture is the Yodlee platform, an enterprise data aggregation network. The scale here is immense. A single central user node on the Yodlee network branches outward to connect with 12,500 distinct external data source nodes, ranging from banks to individual billers. Of course, this introduces an immediate engineering problem. Raw, unstructured data is pouring in from thousands of diverse, completely incompatible sources. To make this information useful, it requires a proprietary multi-step normalization process. The raw, chaotic data flows through a central algorithmic filter, emerging on the other side as uniform, color-coded, standardized blocks. This cleaned data allows the system to extract metavariables. A metavariable is predictive data generated by identifying patterns across multiple underlying datasets. Instead of a static numerical score, these metavariables generate a real-time, highly accurate financial personality. By overlaying thousands of data points, the system achieves granularity through scale. Previously invisible consumers become highly predictable. Back-end processing is a technical achievement, but data sourcing requires navigating strict consumer privacy boundaries. The CFSI defines this dynamic as trend number 3, opening the books. It represents a data trade-off economy. In this trade-off economy, users voluntarily opt in to share their deeply private financial datasets. In exchange, they receive tangible benefits, like lower loan rates, tailored product offers, and custom insights into their spending. This active, voluntary opt-in architecture is a strict departure from the legacy practice of passive, unconsented data scraping. Innovators like Visual DNA and Hello Wallet actively communicate their data usage logic directly to consumers. The CFSI categorizes this transparency as trend number 2, connecting the dots. This transparency creates a closed-loop system. Sustained, willing user engagement continuously feeds high-quality information back into the machine learning models, constantly refining their accuracy. Highly predictive underwriting scales effectively when consumers are treated as partners in the data exchange, not passive subjects. None of this matters without industry adoption, which the CFSI identifies as Trend 4, hitting the target. Application Programming Interfaces, or APIs, allow B2B platforms to plug directly into these normalized data pools for instant decisioning. Notice how the central node connects to a vast ecosystem of institutional lenders, like OnDeck and Cabbage, all pulling from the same shared data pools. As these platforms become the industry standard, predictive algorithms become exponentially smarter across the financial sector. The contrast is clear. Left, the rigid 30-day billing timeline. Right, the dynamic, predictive power of the multi-layered data mosaic. Integrating massive alternative datasets reduces institutional risk while simultaneously rewriting the rules of financial access. Underserved consumers use this to prove financial resilience through the evidence of their daily lives.